Thanks for joining us this morning. My name is Lauren Emenacker, and I'm with the Vail Valley Partnership, the Regional Chamber of Commerce. And we just wanted to say thank you for joining us for some of these webinars. We're excited to be able to bring you content to the comfort of your own home. You will be muted for this webinar so that we're able to hear Paul. And if you have any questions, please put them in the chat box, and then I will ask them to him at the end. So without further ado, I would like to introduce Paul Wisor with Garfield Hecht. Paul's practice focuses on public finance, real estate development, and land use. Today, he will be talking about legislation since COVID-19 and the impact on employers and employees. So without further ado, I will hand it over to Paul.
Thanks, Lauren. I really appreciate it. And thank you to the VVP for hosting this morning. I think that we're all kind of struggling to figure out what the best next thing to do is. And it gets more confusing as you consider the state and federal legislation and rules that are coming at us at a rapid pace. So today is meant to kind of give a wide view of the regulations that have been coming down that address the COVID crisis and give employers as well as employees a perspective as to how the community can benefit from some of these regulations, as well as how some of these regulations are placing a burden on some businesses. We're also going to touch on how governments are benefited by the federal legislation, because I think it's important for businesses and employees to understand what it is that our local governments can and cannot do at this point. So without further ado, let me throw up a PowerPoint, and I apologize, it's going to take a second to load up here. All right, Lauren, can you see that?
Yep, we're good to go.
Great, perfect. All right. So I think as everybody knows at this point, let's see. Sorry about that. I think as everyone knows at this point, the federal government has taken now 3.5 steps, as we like to say, as of yesterday and today, to address the federal stimulus legislation. Phase 1 was a pretty large program, or at least we thought so at the time, $8.3 billion. That was kind of quietly distributed throughout the federal government to prepare agencies in order for them to respond for what clearly at that time was the incoming crisis. Stage 2 or phase 2 was a federal program that was aimed at the workplace. And the idea was that, okay, we understand that COVID is coming, but we don't want people going to work and infecting each other. So let's figure out a way to deal with that. Phase 3 was the CARES Act, which I think most people are now fairly familiar with, and that was a $2 trillion program that provided direct aid to businesses and small businesses in particular. And then phase 3.5 is currently the phase that we're in. It was passed by the Senate by voice vote on Tuesday, and should be passed by the House in the next few hours, and probably signed by the president yet today, if not tomorrow. And so we're going to mostly focus on phases 2, 3, and 3.5. And of course, if you have any questions, feel free to ping Lauren, and we can address those as we go along. So we're going to kind of do this chronologically in terms of the development of COVID-19 throughout our society. And so as I said, as the virus was coming to our shores, Congress realized that it was a pretty bad idea to have people getting infected, especially given that they potentially could be asymptomatic and going to work. And so particularly for those people who were sick, Congress decided that they wanted to at least provide an incentive for people to stay home, for people to not feel like I have to go to my job in order for my continued survival to really be viable. And I need that paycheck. And so Congress stepped in and said, if you are sick, we're going to provide some sort of mechanism for you to stay at home. And that mechanism came in the form of what is called the Family Medical Leave Act, and then an emergency pay provision. And we'll discuss those each in a second. But I should note just at the outset that for employers, this all sounds very expensive when I start talking about it, but you have to remember at the back end, there are tax credits that are available for most small businesses and nonprofits. So it should not be too onerous at the end of the day. I should also note that these employment programs are applicable to employers with 500 or fewer employees. So that's actually most of the employers in the Valley, with, of course, the exception of Vail Resorts. And there is a very small business exception. And it basically says that if having an employee out because they're mandated to have leave under this federal legislation would cause your business to essentially fail to operate, or would be unable to operate at minimal standards, then you are able to get a waiver and not provide the leave to the employee under these programs. But when you read that waiver, it is very, very narrow. My understanding, however, through guidance and then just through reporting, is that the Department of Labor is going to take a fairly broad view of that exception. And so if there are very small businesses who feel like they can't operate with employees, it is likely that that waiver would be granted. So let's quickly talk about the FMLA provisions. And the FMLA is the Family Medical Leave Act, and I think most people are generally aware of it. It's not a new act, and it requires employers to provide 12 weeks of leave generally. And so I think we all are kind of familiar with that concept. Typically, that 12-week leave is an unpaid leave, but under FCRA, the new legislation that was passed, that particular leave is now paid leave. And it can be used if the employee cannot work or work from home because he or she has to care for a child who is staying at home due to a COVID closure. And so that would apply to pretty much any employee who has a kid in childcare or in school, because most childcares and most schools are now closed. Now, there's a question as to what happens when those child cares are not closed because of a government order. So going forward, there might be some child care facilities that decide we're not going to open, even though Governor Polis is opening up the state. Similarly, it's a little unclear what happens when school ends, because it's not a default that kids would necessarily be going to Mountain Rec, for example. And so the way the legislation is written, it's a little confusing as to what comes next. But generally speaking, if you have an employee who needs to stay home to take care of their kids because they are at home, they're entitled to 12 weeks though they're paid at 2/3 the rate of pay, up to $10,000. I should note that additional guidance from the Department of Labor made clear that if you have a child who's 14 and older, you are not eligible for this particular leave, because the thought is that the high school kids can take care of themselves and you can go to work. So that is the FMLA obligations on employers. Now, separately, there's an emergency paid leave, and it provides that if you are sick for certain reasons due to COVID-19, you may stay at home and still get pay. And this is a separate paid time off program that's made available to employees that is different than any sort of PTO program that they might already have with their employers. And you can see the reasons for this COVID-19 leave, as I call it, listed up there. And I really break them out into two categories. It's either I'm caring for myself or I'm caring for someone else. And if I'm caring for myself, I'm entitled of up to $511 per day while I'm out for those 80 hours. And if I'm caring for someone else, I'm entitled to $200 per day. And so this is really a mechanism to encourage people to stay home. And even though, in Colorado, the stay-home order is being lifted and presumably people are going to be feeling better, it is still obviously possible that people are going to contract COVID, get sick. And so this legislation doesn't go away just when the stay-home orders are lifted. If you get sick with COVID, these provisions still apply for the foreseeable future. Now, that's all well and good for most people who have a job, but the reality is, especially in this valley, that a lot of businesses have closed and laid off or otherwise furloughed their employees. And so these sick leave provisions don't do a whole lot of good. And so I think it's important to address what happens to those employees who have been let go. And hopefully, if people are in that position, they're obviously aware that under Colorado law, they're entitled to unemployment insurance. under Colorado law, you're paid 55% of your compensation up to about $561. There's another calculation that can get you up to about $661, but most people aren't going to be eligible for that particular calculation. So that's always been the law, if you've been let go of your job through no fault of your own. But the CARES Act, which is the phase 3 legislation that the federal government implemented, provides an additional layer of protection for unemployed workers. And it adds additional $600 a week to that $561, or at least a maximum of $561 that an employee might be entitled to receive. The CARES Act also provides an additional 13 weeks of unemployment insurance. And it expands the pool of those who are eligible for unemployment insurance. It used to be that independent contractors, gig workers, and those that didn't have a significant work history would be unable to obtain unemployment, but the CARES Act modified that, and so now they are eligible. So a couple of things about that. Because that is a new eligibility pool, the Colorado Department of Labor had to basically establish a new protocol in order to process those applications. That particular portal on the Colorado Unemployment website just went up this week. And so while people have theoretically been able to apply for this type of relief for a couple of weeks now, it is only being processed just now. A second thing to note is that the system, both in Colorado and throughout the nation, the unemployment system is incredibly overwhelmed. And so even if you find yourself unemployed, you can go ahead and apply, but it is still taking about 6 to 8 weeks in order to process those applications. And so it is possible that you are going to apply and then not receive a check from the state until 6 to 8 weeks later. Now that check will backfill you from the time that the application was processed, but it is going to put some employees in a tough position because not everyone can go ahead and just float 6 to 8 weeks of not getting paid. The final consideration relates to the $600. That doesn't need to be applied for separately through the federal government. That gets processed when you apply through the state. However, it should be noted that there are instances where there are some employees, and this is a conversation that employers need to have with themselves. There are some employees who make a certain dollar amount below a certain threshold, wherein because of the $600, it makes more sense for those employees to be laid off, because when you calculate the 55% pay they're going to get from the state plus the $600, that's actually more money than they're making with the employer. So while a lot of employers want to keep folks on, there are some employees who would actually benefit from being let go. Now, that analysis works for, say, a 21-year-old who doesn't have a family and can either access their parents' health insurance or have access to otherwise cheap health insurance, then that calculation makes sense. But if we're talking about a primary breadwinner who has a family to think about, that healthcare cost is astronomically high. And unless the employer is willing to float the boat on that in some sort of way, that employee is not going to be in a great shape, even if they're receiving those $600. So for employers, I think that's an important concept to keep in mind. So that's kind of the employer-employee relationship, but let's talk about what the federal government has been doing for businesses lately. And I think everyone is likely aware of the Payroll Protection Program, or the PPP. It is a new program under the pre-existing Small Business Administration Loan Program, which is known as the 7A program, creatively named after the section of the Small Business Act in which it's found. And the SBA program is generally eligible to certain small businesses, but you have to meet certain requirements. All those requirements have been waived for the PPP program, and it's now just available to businesses with fewer than 500 employees. These SBA loans are typically 80% guaranteed by the federal government and require a personal guarantee by the business, as well as some collateral. The PPP loan is 100% guaranteed by the federal government, does not have any collateral requirements or personal guarantee. So this is 100% guaranteed by the federal government. If you apply for the PPP program, you're eligible for a loan of up to 2.5 times the business's monthly payroll cost, which is measured over the previous 12 months, or up to $10 million. I suspect most businesses in the Valley will be looking at that 2.5 times number. And so payroll cost is a fairly generous term. It includes not only the amount that you pay out in terms of just straight payments, but any vacation time or health benefits that you're getting. So it's a pretty wide definition and should be able to capture everything that you would need to either keep an employee on, even if the business isn't open, or to rehire people and continue to pay them as you previously were. And the whole idea behind the PPP program is we want people to continue to receive income, even if the business isn't open. And it is, I suppose, possible that the federal government could have just given direct checks to certain people. But I think, as we'll discuss in a moment, direct pay isn't working all that well. And this was seen as a more effective, although perhaps slightly economically inefficient way of doing, of accomplishing the goal of keeping people paid. So if you get this loan that's up to 2.5 times the monthly payroll, you then have 8 weeks in which the entire loan can be forgiven. And so that loan can be forgiven if you pay your payroll costs, or interest on mortgage payments, pay rent, or pay utilities, essentially. And the Treasury Department, after the CARES legislation was passed, implemented some new rules and said now that in order to achieve forgiveness, at least 75% of those costs have to be payroll costs. So 75% of your loan in those 8 weeks has to go to paying folks, because that's kind of the main goal of this program. And so I think it's important to, one thing that I really want to emphasize is that people, and this was actually brought up in the Vail Daily, that people are under the impression that when they contact their bank or they get an application with the SBA, that's when this program starts rolling for them. And your forgiveness period doesn't begin until the date you receive money in your bank account. You have 8 weeks from that date to have loan forgiveness. And so I think that's really important for people to remember as they're making decisions to hire people, to keep people on, or to continue their business, because that timing, I think, will really matter in people making those decisions. So I think it's crucial that people remember that. Now, I think it's also important for people to realize that unlike most SBA loans, the PPP program is administered by private banks. And so rather than applying to the SBA, you will apply to a private bank. And we're going to talk about a little bit more of those details when we talk about the new phase of this legislation. The other major source of assistance that's coming from the federal government are what is known as funding of economic injury disaster loans. These EIDL loans have been around for a long time, and they are available of up to $2 million to a borrower, and they can be used to pay not only payroll and rent and the other items that PPP loans are available to pay, but you can also pay debts and things like inventory. It's not a forgivable loan, but it is an attractive loan in that for small businesses, the rate is 3.75%, and for nonprofits, 2.75%. And that loan can go up to 30 years. So if you are a successful business before March 1st, this is probably a loan that you will be able to repay with a good amount of ease. There are separately what were they called, emergency EIDL loans, and that is a forgivable $10,000 loan that you can get right now by applying to the SBA. And so that forgiveness will be available to you, but if you then apply to a PPP loan, that amount will be applied to the forgiveness. And so, for example, if you get a PPP loan that is in the amount of $100,000 and you spend all that $100,000 within the 8-week period for permissible purposes, you're only going to get $90,000 of forgiveness because you've already been given that $10,000 emergency loan. So you'd have to repay the remaining $10,000 of the PPP loan. And I should have mentioned this before, but the PPP loans have a repayment rate of 1%, and they have to be repaid in 2 years. So if you obtain a loan, spend some amount that's forgivable, but not all of it is forgivable, then that loan will be repayable within the next 2 years to the bank with whom you got the loan from. So I think that's all good news for businesses. I think it's important for everybody to remember that, especially employers, as they're thinking about what to do with their employees, there is direct payments coming. Some people have already received their $1,200, and individuals who are making $75,000, or married couples who are making $150,000 are certainly entitled to that $1,200. People who are making above that will have a phase out. I think, as most people have read, the implementation of this direct pay has not been as efficient as people had hoped. There have been a lot of checks that have ended up out in the ether, gone to the wrong place, or simply haven't been processed yet for a variety of reasons. Mostly the fact that my understanding is that the IRS infrastructure to process these checks is about twice as old as I am. And so they're trying to catch up and figure out how they can do this in a more efficient and expeditious way. But there's a good amount of our community should be receiving some money from the federal government between now and the end of the year. So that was all the CARES legislation. We should talk about the Payroll Protection program that is in the process of being passed. I think relevant to our conversation, it puts a lot of money into the PPP and EIDL loan programs. It does give a ton of money to hospitals, which obviously is great. But I think for right now, we're going to talk about the PPP program. I think, as most people know, the PPP program received $349 billion in funding through the CARES Act. That money went away in about 3 weeks. And so this latest bill that was passed this week drops another $310 billion into PPP loans, another $50 billion into EIDL loans, another $10 billion into the EIDL grants. So there's, the programs are being reinfused with cash, but up until the president signs that legislation, none of this money is actually going to be available. In fact, the SBA site, I just checked before I got on, it still says that due to lack of appropriations, they're not processing any of these loan applications at the moment. And I think all banks are taking one of two views. One is that they will take an application on the view that this is going to get passed and there will be more funding coming. Other banks are saying, we have certain regulatory obligations. We're not comfortable taking your application, but please give it to us as soon as the president signs this legislation. If you have not applied for this loan, for a PPP loan or an EIDL loan, or you're thinking about it, I would strongly urge you to do so. These loans went so quickly on the first round of funding, and I would only imagine that's going to be the case the second time around. I think they were going out at a rate of about, when you took out the amount of money banks were putting out each day after the program began, it was about $20 million a day. So you can do that math and guess that there's probably about 2.5 weeks of funding. And so, some large banks like Wells Fargo, I know, have a very long line of people who, they're going to try and fund those loans, but it is not guaranteed that if you go and simply apply today, you are going to get it. But the longer you wait, the lower the probability is that you are going to get funded. One note about the banks, I strongly suggest that you apply for your loan with the bank with whom you have a current relationship with. Because this program is so new and was put together so quickly, a lot of banks are very concerned about their risk in terms of liability if fraud were to be committed. And so they are operating on the assumption that they want to know their customers. And so they're not providing these loans to new customers. Now, that is the general rule. I have heard that there are some banks who are willing to provide this loan if you as a business are willing to move your entire banking relationship over to those banks. And so if you get no from your bank, and I would say in particular, if you get a no from a larger bank, I would call around, especially around the Valley, and see if any of the other local banks or even some of the smaller banks on the Front Range would be willing to take you on as a new client and start servicing your business. And if the answer is yes, then they should be able to provide a PPP loan to you. I would also note one thing about the banks. I think they've been getting a little bit of a bad rap in terms of the processing of all this. I've been working with a bunch of banks, and I think they're doing a great job. Unlike the last financial crisis that we were in, this crisis is not of their making, and they're not actually making a lot of money off of this. As I noted, the interest rate on the PPP loans is 1%, and most of that is forgivable. So it's not as if the banks are seeing a lot of money through this. So I think when you're talking to a very tired banker, it's important to keep that in mind. Finally, I just want to touch on local government aid that is available. Under the CARES Act, there was $150 billion that was made available to state and local governments. Colorado is going to get about $2.2 billion of that. Unfortunately, the way the CARES Act is written, only local governments with populations of over 500,000 are going to be eligible to receive these dollars. So that essentially means the city of Denver is going to get some money, and then Jefferson, Adams, Arapahoe, El Paso, and Arapahoe County are going to be getting these funds. Every other governmental entity throughout the state is not going to see a dime of this federal money, and that includes Eagle County, Gypsum, Eagle, Avon, and Vail, and Minturn. And so while it'd be great if the state would pass along some of this money, there's no requirement in the legislation that they do so. Congressman Neguse, who represents Avon and Vail, all the way over to Boulder, has introduced a bill to provide $250 billion of funding to local governments. We'll see if that goes anywhere. But at the moment, I think the expectation should be that none of our local governments are going to see any of these funds, or at least any of these federal funds. And so when we're looking to the town of Vail or the town of Avon to do something, I think it's important to remember that they only have the ability to go into the money that they had on the bank, as of March 1st, and they're cutting budgets now, and they have to balance their budgets. They're not allowed to go into debt. So the flexibility for some of these governments to provide aid is certainly limited, though I think every local government within the Valley is trying to figure out what they can do without breaking their budgets. So that was a really quick overview of kind of the federal efforts that have been going on right now. I guess the last thing I would say, or just touch on really quickly, is that Governor Polis has indicated that the stay-home order will be lifted, obviously sooner for Eagle County, which is great news for businesses. Unfortunately, he hasn't, while he's made a lot of pronouncements, we haven't seen any of the actual orders. And so if I were a business owner, I would be cautious about my ability to open based on what the governor said. I'm not saying that the governor is misleading anyone or is incorrect, but it has been my experience since these orders, both from the state and federal government, have been put forth, that things are subject to change when they're put on paper. And so I think it's great that we have the opportunity to slowly get back to business, but I think it's important to see what those regulations actually say before any plans are really put in place. With that, Lauren, I'll turn it back over to you.
Sounds good. Thank you so much. So we do have a few questions. The first is, have you heard of any solutions to those who have left a restaurant and are not returning because the unemployment checks are more than what the restaurant can pay?
You mean from the employer's perspective?
Yeah, are there any solutions for the employer to be able to bring them back?
Yeah, I mean, so one of the solutions is to offer them their job back, because once you have, if you're on unemployment, you have an obligation to search for employment, and it is possible that as the employer, if you offer employment to the recipient of that unemployment, of the unemployment insurance, they don't have to take the job, but they are strongly encouraged to do so. And so I think at least making that offer then puts the employee in a position of potentially jeopardizing their ability to collect unemployment going forward.
Okay, and just to clarify on that a little bit, so I think also part of it is having that some people aren't taking the job back because they're actually getting more from unemployment, like you mentioned.
Yeah, and it is a problem. I think there are a couple things to remember. The $600 is only going to last through July, and so I think it's possible that some employees are going to do the math and realize they would rather have a job now. And take that job, but then also realize that if they wait till July, it's likely that someone else is going to take their job. And so I think it's important for employers to remind them that the $600 calculation is only going to last for another 3 months. But again, I would make sure that you affirmatively give them a formal offer, because then they have to report that and they have to have a conversation with the unemployment office as to why they didn't accept that offer.
Okay. And still on the unemployment kind of track, is how soon do you think people should file for unemployment, given that there are those long wait times and everything?
As soon as possible because of that long wait time. So as soon as you know that you're going to be losing your job, I would file. Even if you've been given notice that we're going to keep you on for another week, I would fill out my application, marking that my separation date is in this, say it's May 1st. I would indicate that because your application isn't going to get processed before then.
Okay. And is there an exception to paid leave for small businesses?
Yeah, and I touched on that a little bit, and it's a little, I will say my answer isn't great because it's a little confusing at the moment. The way the legislation reads is that there's a very narrow exception. You basically have to be unable to function without that employee who's going to be taking the leave. But, and I think that's just a really hard standard to meet. But what the Department of Labor has indicated in some of their guidance and what some of the statements have been coming out of the Department of Labor have been that they're going to look at those waivers for those exceptions very broadly. And so especially the smaller the business, the more likely they are to say, yeah, you don't have to comply with it.
All right. And then one more question. Unless anyone has any more, please put them in the chat box. But otherwise, we'll have this be the last. So does the federal legislation change anything with healthcare?
It's a good question. One I get a lot. So it changes your healthcare in that if in that healthcare, your health insurance provider needs to provide for your testing and cover your testing. But other than that, your healthcare is going to remain the same.
Perfect. So there's one more question that just came through. And it's if you can speak about any special considerations for self-employed folks.
Yeah, and so this is a really important point, actually. Self-employed people used to not have eligibility for SBA loans or for unemployment. Under the CARES Act, they are now eligible for both. And so if you're an independent contractor or basically if you're an independent contractor and have been getting paid by what you consider your employer, but you're really an independent contractor, you can separately apply for the PPP program and say, this is the salary that I was making or paying myself, and you're entitled to 2.5 times that. And if you spend that on your own payroll, which is you, then that loan is forgiven within 8 weeks. So it's a really fantastic deal for independent contractors and sole proprietors. Separately, if the PPP isn't available because unfortunately you didn't have a pre-existing relationship with a bank who was able to process your application, or the SBA hasn't been able to process your loan request yet, then you now are eligible for unemployment. That portal is at least functionally up. I haven't tried to get through and see how well it's working, but should at least be available. But if you are in that situation where you're an independent contractor, I really would encourage you to apply for a PPP, because you, unlike Ruth Chris Steakhouse, is who this program is intended for.
Perfect. And then at the beginning of your presentation, you touched on the employee retention credit. And what were the details and how can that help owners?
Yes, and I should have got to that, so thank you for asking. The credit is based on the Social Security tax that employers are required to pay, and so there will be a credit based on that tax that you have to submit quarterly. Now, it's an interesting situation because most businesses are closed right now, or at least not doing a ton of business, and so presumably that liability is going down a little bit. And if it's the case that your sick leave that you're providing exceeds the amount of tax liability you have, then there will be a direct payment made to you. The credit will go on your the corresponding quarter in which your taxes are due, and so you get relief within the quarter if your tax liability exceeds the amount of sick leave that you paid out. My understanding, and this is one of those things that still has to work itself out through regulation, is that the direct payment probably isn't going to come until the end of the year, so that reconciliation is going to take a little bit longer.
Cool. Well, thank you so much for joining us today and giving us this overview. We'll have some more webinars coming up, so definitely stay tuned at vailvalleypartnership.com and let us know how we can support you. Oh, wait, it looks like there's one more, Paul, if you don't mind.
Sure, absolutely.
So let's see. So a business that started on February 1st, 2020, what advice do you have for them in applying for a PPP loan? So specifically kind of those newer businesses to start up right before this happened. Yeah.
So I guess the good news is you're eligible, just barely, because the eligibility cutoff was February 15th. The bad news is that your payroll calculation for the PPP is going to be those 2 weeks. Well, it's actually, I shouldn't say it's that bad. It's going to be February through March that you probably were up and running and doing well. But they're going to look back from the day you apply to February 1st. And so your payroll probably isn't going to look exactly how you would want it to look. But that said, you're entitled to 2.5 times whatever that payroll looks like. And so hopefully that calculation will be useful. But I think I would really work with your bank, because I've noticed that some of them are willing to be flexible in terms of how they're calculating that average. The look back period is supposed to be a year. There are opportunities for that look back to be just the last quarter. And so I think that you really need to try and capture all the payroll costs that you possibly could have had in order to juice that number as high as it'll go. And that's really the best advice that, for the PPP program. The SBA program, potentially could be a better avenue. Yeah, there's, it's not entirely forgivable, but it doesn't have any sort of payroll look back. And you can take out up to $2 million as a new business. You wouldn't want to do that. But, that might be a more attractive option if you're really trying to figure out how to get money in the door.
Cool. Then I think that is about it. Thank you so much for answering all the questions and doing this presentation today.
Thank you. Everyone hang in there.